Welcome to Global Markets Daily Brief. I am Jonathan Simkovitz. It is Tuesday, the 31st of March, 2026. Every trader, every portfolio manager, every risk desk on the planet is asking the same question today. What is the end game for the United States in the Iran war? But that is the wrong framing. The real question is this: what are markets pricing as the end game? And how wide is the gap between that assumption and the range of actual outcomes? Because right now, capital is making a very specific bet. It is betting on a negotiated de-escalation within 1 to 4 weeks. If that bet is right, you have a generational long opportunity in risk assets. If that bet is wrong, you have a supply shock that reprices inflation expectations, growth forecasts, and the entire yield curve. That divergence is the single most important capital allocation question in global markets today. So let us walk through what happened. This morning, the Wall Street Journal reported that President Trump told aides he would be willing to end the military campaign in Iran even without a full reopening of the Strait of Hormuz. He then told the New York Post the war would not last much longer. Defense Secretary Hegseth said the coming days would be decisive and noted that Iran launched fewer projectiles in the last 24 hours than at any point during the conflict. Equities surged. The S&P 500 rallied roughly 2.5%. The Nasdaq jumped more than 3%. The Dow gained over 1,000 points. Oil, which had risen nearly 50% since the war began, pulled back to around $102 a barrel. Treasury yields fell. Gold rose above $4,600. The VIX dropped about 15%. Risk on across the board. That is the first-order reaction. Let's step back. The consensus view forming on trading desks right now is that Trump wants out. He sees oil at $4 a gallon at the pump. He sees the S&P 9% off its highs, flirting with correction territory. He sees consumer confidence barely holding. He has extended his own deadlines to Iran twice already, from March 21st to March 27th, and then again to April 6th. The pattern, the consensus says, is a leader looking for an off-ramp. And there is some evidence for this view. Pakistan is facilitating indirect talks. A quadrilateral group including Saudi Arabia, Turkey, and Egypt met in Islamabad over the weekend. Trump's language has shifted from unconditional surrender towards something more ambiguous. He has started saying regime change has already occurred, referencing the killing of Khamenei, which lowers the bar for what counts as victory. But here's what the consensus may be getting wrong. The gap between American and Iranian negotiating positions is enormous. The United States has offered a 15-point plan. Iran has rejected it and countered with 5 conditions that include reparations, recognition of Iranian sovereignty over the Strait of Hormuz, the closure of all American military bases in the region, and an end to Israeli operations in Lebanon. These are not starting positions for a quick deal. These are maximalist demands from a regime that publicly refuses to even acknowledge that negotiations are happening. And this is the critical piece that is not priced in. There's a very real possibility that the April 6th deadline passes without a deal, which then forces the president into a binary choice. Either he escalates by striking Iranian energy infrastructure, oil wells and power plants, as he has publicly threatened, or he backs down for a third time, which weakens credibility but removes the tail risk. Markets are pricing the second option as near certain. I am not convinced that probability is as high as equity prices suggest. Meanwhile, the physical energy market is telling a different story than the futures market. Diesel and jet fuel prices have already breached $200 a barrel in parts of Asia. Fuel shortages are emerging from Pakistan to Thailand to Australia. Qatar has declared force majeure on its liquefied natural gas contracts. The International Energy Agency has called this the largest supply disruption in the history of the global oil market. Urea prices are up roughly 50%. Fertilizer supply chains are fracturing. These are not conditions that resolve quickly, even if a ceasefire is announced tomorrow. There's also the question of the strait itself. Even under a deal, reopening Hormuz is a logistical and insurance nightmare. Lloyd's of London has designated the entire region as high risk. Tanker insurance premiums have repriced dramatically. Ship owners are not going to rush back through a waterway where over 20 merchant vessels have been attacked in the last month. Physical flows will lag any diplomatic agreement by weeks, possibly months. My base case is that some form of indirect agreement is reached before the April 6th deadline, but that it falls well short of restoring pre-war energy flows. The most likely outcome is a partial ceasefire, a gradual reduction in hostilities, but a Strait of Hormuz that remains functionally impaired through the second quarter. Oil stays elevated, not at 120, but not back at 60 either, somewhere in the 80 to 100 range on Brent, which is enough to keep inflation expectations elevated and enough to prevent the Federal Reserve from cutting rates this year. On that point, Fed Chair Powell spoke yesterday at Harvard and said policy is in a good place to wait and see how events in the Middle East unfold. Markets initially priced a greater than 50% chance of a rate hike this year. After Powell's comments, that probability dropped to around 5%. Powell is clearly telling you he does not want to hike into a supply shock, but he also can't cut. The Bloomberg Economics Tracker already has March CPI at 3.4% year-on-year, up a full percentage point from February. The Fed is trapped. That is a critical backdrop for asset allocation. Now the trade-off matrix. The base case, a messy, partial deal. Oil settles in the $80 to $100 range. The strait partially reopens over several weeks. Equities recover some ground but remain below January highs. The Fed stays on hold through the end of the year. Growth slows to roughly 1.5% but avoids a recession. This is the most probable outcome. I would assign it roughly 50 to 55%. The bull case, a comprehensive agreement is reached quickly. Iran accepts meaningful terms. The strait reopens within days. Oil falls sharply towards $70. Equities rally hard, potentially retesting all-time highs. Rate cut expectations return. The growth outlook brightens. I would put this at 15 to 20% probability. It requires Iran to capitulate in ways its leadership has publicly and repeatedly refused to do. The bear case, talks collapse. The April 6th deadline expires. The United States escalates by striking Karg Island or Iranian energy infrastructure. Iran responds by intensifying attacks on Gulf state energy assets. Oil goes to 150 or higher. The strait remains closed through the summer. We get a genuine stagflationary shock. The Fed is forced to consider raising rates into a slowdown. Equities enter a bear market. Credit spreads widen significantly. I would assign this 25 to 30% probability, and I would argue that is higher than what equity markets are currently pricing. There is an additional tail risk that deserves mention. The arrival of the USS Tripoli carrying Marines in the Indian Ocean raises the prospect of a ground component. Even a limited operation to seize Karg Island would represent a dramatic escalation that would reprice every asset class simultaneously. This remains low probability, but the optionality is clearly being maintained by the Pentagon. What to watch in the coming days? First, the April 6th deadline. If Trump extends it a third time, that confirms the pattern and supports the base case of a slow, messy negotiation. If he does not extend it, markets will need to rapidly reprice escalation risk. Second, physical tanker traffic through the strait. Forget the headlines about diplomacy. Watch the Lloyd's List data. Watch the vessel tracking services. If tanker traffic begins to tick up even slightly before a formal agreement, that is the strongest possible bullish signal for risk assets. If it remains at zero, no amount of diplomatic language will matter to the physical oil market. This is market commentary, not financial advice. Markets move on narratives. Capital moves on probabilities. If you found this analysis useful, subscribe to Global Markets Daily Brief. We publish every trading day. I will see you tomorrow.